We need to be good at sussing out.
You can do it from any point. Let's collaborate instead of compete.
Hey, everybody. Welcome back to the Mentor Nation podcast. If this is your first time here, my name is John Abbas, and I host this show each and every week as we interview just incredible entrepreneurs, awesome creatives, people just doing really, really cool things all over the world. We have a really great guest today. Very excited about this interview. But before I bring him on, just do me a favor. Take a second, hit that subscribe button, whether you're watching this on YouTube, listening to this on Apple, just hit the subscribe button. I want to make sure that you get a notification each and every time I release a new episode, which is approximately every 1 to 2 weeks. So it's kind of funny, actually, as I publish this episode, gold is reaching like all-time highs. I think it just crossed $2,000 an ounce. But I recorded this episode about 2 months ago when gold was way below what it is now. And my guest today, he called it. Dave Garofalo is probably one of the top names in the world, top experts when it comes to gold. He's the chairman and CEO of Gold Royalty, which is a publicly traded company that engages in the acquisition and management of over 200 royalties throughout the Americas. In this episode, Dave shares a lot about his story, his company, and then we really dive into gold. And that's what I want you to pay attention to. Dave shares his wisdom on why he believes gold is headed for a boom in the near future. And $3,000 an ounce is not only possible, but likely. And so if you have any interest in precious metals as an investment, then this episode is perfect for you. So enjoy. All right, David, we're recording. Thank you so much for being on the podcast. I'm really looking forward to this interview. It's not every day you have the CEO of a publicly traded company on your show. So very excited to have you on today. And thank you for being here.
I'm delighted to join you. Thanks, John.
Absolutely. So for those of you guys listening, David is the chairman and CEO of Gold Royalty Corporation, which is a publicly traded company. They have a massive portfolio of gold royalties and probably some other things, which we're going to talk about. And so, David, I was really hoping that today you could educate us on your story and then on gold in general. You know, I know there's a lot of myths out there. Some people are diehard gold fans. Some people are naysayers, but I think a lot of people don't really understand it, especially to the level that you do. And so I was really hoping that you could share your stance and just as an investment and a way to preserve capital. But first, I always want to get into the story behind the person before we get started. So can you just share a little bit about that and how you rose to be the CEO of Gold Royalty?
Well, I've actually been in the mining business for close to 35 years. Started out in the financial services side with Deloitte's back in the 1980s, and then joined a small base metal company and worked my way up from there. I was the CFO of Agnico Eagle for 12 years, one of the biggest gold producers in the world. Was there from its very beginnings to being one of the largest cap gold producers and the biggest producers of gold in the world. Ran Hudbay Minerals on the copper side for about 6 years and built several mines there throughout the Americas, and then ran Gold Corp, one of the biggest gold producers in the world. And I led the merger, the largest merger in gold mining history with Newmont back in 2019, a $32 billion merger, which created the world's biggest gold company by market cap and by production to this day. And then about a year and a half, 2 years ago now, we IPO'd Gold Royalty Corp with my partner Amir Adnani, now creating one of the fastest growing, it is actually the fastest growing royalty company in the entire gold space.
That's really incredible that you've been able to do all that, but that you've been able to sum that up into 30 seconds. That's like really, really incredible. You know, it's funny about you say Deloitte, like they're everywhere. Our whole family took a trip to Iceland recently, and you know, you don't notice anything, and then just right there in the middle of downtown is Deloitte, and we're just like, wow, like they're even here. Like
that's been a recurring theme throughout my career. Every company I've been involved with, from financial services through the mining, has been international in scope, and I've had the good fortune of being involved in the construction of 15 mines in the world, copper and gold. and operated countless more. So it's given me, I think, a unique perspective for a royalty player. Many of the royalty companies are run by financial engineers, and I would say most of my board and management are mine builders and operators. So we provide quite a unique perspective for what's effectively a financial provider to the mining sector.
Huh. I have one more question just on what you were speaking about earlier. What's it like taking a company public? Like, is it really exciting?
It is, and it certainly helps when you have a robust market, which we had in early 2021 when we IPO'd Gold Royalty Corp. We were looking to raise $30 million US. We ended up raising 90 million. We had $140 million of demand for the stock. So we were able to triple the size of our IPO from what we originally envisaged. And that gave us a very strong currency. And that meant we entered 2021 with a lot of momentum. And that allowed us to pick up 3 other companies. We merged with 3 other companies. We pursued a roll-up strategy. And we increased our royalty portfolio more than tenfold. We started with 18 royalties. Today, we have 215 royalties in our portfolio.
That is incredible. Like, very, very, very impressive. So I wanted to pivot into just your philosophy, because especially anytime I have a guest on that has tremendous influence in the world of finance or economics or commodities, I always really like to get their opinion on just the current state of the economy and what your opinion is on, just with all of the hikes and inflation. What do you think the government is going to do the rest of 2023? And what do you think the impact's going to be just in general?
You know that saying, history doesn't necessarily repeat itself, but it certainly rhymes. And there's a lot of similarities in this inflation cycle to what we saw in the 1970s, when we had a significant expansion of money supply as a result of Richard Nixon's decision to decouple the US dollar from gold standard. And that was the finance of war. In Vietnam at the time, they needed to print money in order to finance that, take on more debt. And effectively, that's what's happened this year, this era, in that we have a war in Ukraine and Europe. We had a financial crisis war coming out of the credit crisis in 2008. It was a war of sorts, fighting deflation and fighting the potential ruin of the financial services sector. And so there was a massive amount of printing going on. So like the 1970s, a massive expansion of money supply. And like the 1970s, we had an oil embargo. It was imposed upon us by the Arab world in the 1970s. Today, it was self-imposed because of our dealings with Russia and not reducing our dependence in the Western world to Russian oil and gas supplies. So that's resulted in significant increase in energy prices as a result of that. And, we also saw massive inflation. In fact, the supply chain, oil infected the supply chain this time, that time. We also have a catalyst with the COVID crisis, which ended up exacerbating the inflation and acted as a catalyst for significant headline inflation numbers. The big difference that I see between the last inflation cycle and this one is, in the last inflation cycle, the Federal Reserve, led by Paul Volcker, was serious about tackling inflation. They brought interest rates well above where headline inflation numbers were. I remember 20% interest rates when headline inflation was 14, 15%. So Paul Volcker was very serious, singularly focused on bringing inflation down to a narrow band. And he succeeded over the course of a decade. By the early 1990s, we were down to 2% inflation. And we stayed there until recently. And this time, I really don't see that kind of appetite for the Federal Reserve to do that, because they have 2 mandates. It's not just about taming inflation, but they also have to ensure full employment. Objectives conflict with each other. And the other link here that we have that we didn't have in the 1970s is the massive amount of debt that we've taken on societally. Back then, global debt to global GDP was 100%. Today, it's 350%. On a per capita basis, it's 3.5 times the debt level that we had back then, whether you're looking at the government level, the corporate level, and individual level. So there's very limited scope for the central banks to really raise interest rates without, stimulating or creating bankruptcy situations at the government level, at the individual level, at the corporate level. There's limited scope to do that. They'll want to inflate debt away. And that means that inflation is likely to stay here for a prolonged period of time. because I do think the Federal Reserve will have to pivot, and other central banks will have to pivot over the course of this year, so they don't cause a recession and cause potential significant debt defaults. And that means then that you're going to see a monetary expansion again. And that means your fiat currency, your US dollars, your euros are going to be further undermined in value. There's going to be continued inflation. Your savings are going to be eaten away by the insidious effects of inflation. And really, the one currency that can't be printed is gold. And that's been the case for 4,000 years.
Absolutely. You also made a really great point in another interview that I was listening to you speak on about like inflation, that numbers that are getting posted are not the actual real numbers. Can you speak on that? Because it was really profound and I really loved what you said there.
Yeah, look, the headline inflation numbers are meant to hide the real inflation that we're experiencing day to day in terms of food and energy prices. When they talk about core inflation, it excludes all the things that we need. A roof over our heads, gasoline in our tanks, food in our stomachs. Right. And that's ridiculous. And those are where we're experiencing the greatest pressures on our pocketbooks. And in particular, the poor demographic in our communities, who are always having to spend a significant proportion of their pocketbook on those core
That's right.
core provisions. And they're obviously experiencing significant pressures, causing a lot of pressure at the societal level. And so really, it doesn't reflect the reality on the ground. And it's not meant to. It's meant to give the Federal Reserve as much scope as they could possibly get to lower interest rates to, again, inflate their way out of debt. There's no fiscally responsible way for any of the governments in the Western world to repay their debt without taxing us to 100%. And even if they did that, there would be no economic activity.
Yeah,
so, the only way to really deal with that debt is make it a smaller portion of the GDP. So inflate GDP by allowing money supply to increase and allowing inflation to accelerate.
Gotcha. I don't know how it is in Canada, but have you seen like egg prices in the US?
Same everywhere.
My God.
Yeah. It's milk and eggs. It's crazy. It's double-digit inflation. And that's really putting a lot of pressures on families.
Absolutely. So I want to pivot into gold because this is obviously your area of expertise and you're a huge proponent of it. And so my first question is this is something that I wanted to know. What has the biggest impact on the price of gold going up or down, like historically? Is there any one thing or is it a combination of things?
Well, look, I could certainly talk about demand and supply, and I think a lot of demand is actually coming from investors and central banks because they're recognizing that there's no opportunity cost to owning gold. Gold is a financial instrument; it's a currency, like the U.S. dollar is, like the euro is. The one difference is it's very finite in quantity, and while it yields zero, treasuries, in fact, I would argue, are yielding negative on a real basis because even though interest rates are climbing nominally, inflation is also accelerating. So real interest rates are actually into negative territory. So that's driving capital. And we're seeing that in the early part of this year into gold because of the fact that the relative interest rate in gold is attractive relative to what you can get in treasuries. So it's the right currency to own. And in an inflationary environment where, again, it's insidious, it's eating away at your capital, gold preserves capital because even though it yields nothing, it can't be printed. It can't be undermined by central banks that are looking to expand money supply, inflate their way out of debt. You can't do that with gold. It's the one financial instrument. It's the one currency that's recognized globally. And we're seeing a vast reallocation of capital from the developing world into gold, from central bank reserves in China, in Russia, for example, in Venezuela, where they're dealing with a vast amount of export currency proceeds, euro dollars and whatnot. They're diversifying into gold as quickly as possible because they're concerned about the undermining of fiat currencies. And they also want to be able to protect their central bank reserves from that. And so, for example, China, which is the biggest producer of gold in the world as a country, actually is also the biggest consumer of gold. They not only consume everything they produce, but they also are the biggest importer of gold. So they consume as much of the world's gold as they can. So we've seen a vast reallocation of central bank reserves in China and in Russia and other developing countries into gold in their central bank reserves because they're concerned about the diminishing value of the US dollar on a relative basis. So gold is preserving their capital in an inflationary environment. So that's a big source of demand for gold. And the amount of gold on the Earth's surface is extremely finite. If you look at all the gold that's ever been produced since the beginning of time, it's a little over 200,000 metric tons, which might not be meaningful to people. It's hard to visualize what that means, but it fits in 4 Olympic-sized swimming pools. It's tiny. Volumetrically, it's tiny. So you can imagine a small reallocation of the world's wealth into gold as an asset class. It doesn't need to be significant, would vastly increase the price of gold.
Wow. 4 Olympic-sized swimming pools.
That's right.
That's it. That's wow. That's
and we only add 5% to supply a year. The industry produces about 4,000. We add 2% to supply every year. We produce about 4,000 metric tons of gold per annum as a mining industry. And it's not like we can flick on a switch. If gold went to $3,000 or $4,000 an ounce, we're already at 97% capacity utilization in the industry. It's not like there's spare capacity where we can flick a switch and produce more gold in response to the gold price. There's a remarkable inelasticity of supply to price. We just can't respond. Right. And it's becoming increasingly difficult to permit and build new mines. It's certainly becoming more expensive, but typically from discovery to first production, you're looking at 20 years. So even if there's a doubling or tripling of the gold price, you're not going to see a supply response for 15, 20 years plus. In fact, supply is going down because we haven't, as an industry, been replacing depleting reserves. We haven't been exploring for new deposits. The gold price hasn't stimulated that. So reserves are 40%. Reserves in the ground are 40% below their peak in 2012. And so, in fact, we're seeing mine production steadily come down, which is why you've seen this significant amount of M&A activity, merger activity in the gold industry, because if you're not finding them in the ground, you're going to have to replace it through acquisition. But that just cannibalizes what's already in the industry. It doesn't create new reserves. It just allows existing companies to replace their production and replace their reserve depletion, but doesn't do anything for the industry as a whole. So there is a very positive dynamic for the price in terms of declining supply.
That's really fascinating. So I have a couple questions from my audience that I wanted to ask you. The first one I got was your take on investing in gold versus silver. And I didn't have a great, because I read a long time ago that there was a guy, actually, I think it was Robert Kiyosaki, believe it or not. I think he made a case for silver, and this was over a decade ago. So things could have obviously changed, but the case is that most silver gets wasted in industrial uses, soldering components, things like that. And so we burn through it, whereas everybody knows gold is valuable and they hoard it. What is your opinion on gold versus silver? What do you think is better and why, or does it even matter?
I love silver. I think it's a proxy for gold. And in fact has the potential in a bull market to outperform gold. And the reason I say that is typically the gold to silver price ratio is 40-1 in a bull market. Today it's like 80-1. So that means that in a bull run for gold, people will be looking at silver as a way to get more torque to the precious metal rally. So you have the potential that silver could outperform gold twofold as that ratio narrows back to more historical norms. So if you're looking for a way to get more torque to the gold price or precious metal and you're a bull on precious metals, silver has the potential to significantly outperform. So I'm definitely a bull on the silver market by proxy because I'm a bull on the gold market. The fundamentals are a bit different. You're right. There's much more. There's more significant industrial application of silver than there is for gold. Gold has minute amount of industrial application. It's in your cell phones, for example. It's a great conductor of electricity and whatnot. It's great for electronics, but it's minute. The load factors for gold within our electronic components are tiny, but they're there. But silver is significantly more used in industrial applications. So there is a demand component there that isn't there for gold, but also investors in the precious metal space who are looking for more torque to precious metal rallies will typically use gold or silver, as a proxy for what gold will do.
That really absolutely answered my question, because I'll show you here. I've been buying tons of big bars of silver, like
Cool.
100-ounce like bars. And I have gold as well. And I've just, I always wondered what, like, where I should be allocating. Cause this brings me to my next question, because I mean, obviously for you, gold is an investment because you're buying royalties, which is, correct me if I'm wrong, it's upfront capital for cash flow. Basically, you're getting a percentage of gold mined. But for retail investors, is it really an investment, or would you look at it more of just preservation of capital, storing value?
I think both. And in this environment, this macroeconomic environment where you're concerned about the undermining of your savings, the inflation eating away at it, it preserves your capital. But also, I do think that gold has the potential to rally to well north of $3,000 an ounce. So it could be one of the best performing asset classes. And really what's driving that dynamic is the same dynamic that drove it back in the 1970s. And if you look at gold performance at the onset of that inflation cycle, it hit its peak in 1981 of around $850 an ounce. If you inflation adjust that to $2022, that would be over $3,000 an ounce. So we're a long way away from the real all-time high for gold. And I would argue that the ingredients and the dynamics in this current economic environment are much more supportive of gold than they were in the 1970s because of the factors that I mentioned earlier on in terms of the restrictions the central banks have in terms of really increasing interest rates significantly.
I like that. So that brings me to what you foresee in the near, because gold's on a run up. I looked at this morning, I think it's at 1,900 an ounce. And so what do you think is going to, and nobody will hold you to this, obviously, because there's just too much global craziness like you get on and Ken Griffin is talking about the economy is going to go this way. And then, another billionaire is saying the exact opposite. So there's really, at this point, it's just, you take the data that you have, but what do you think is going to happen in near and medium term for gold?
Well, I mentioned it before, and I can say it much more explicitly. I do think $3,000 an ounce is definitely within sight within months. And gold prices and commodities generally do not go up in a nice steady line. When it happens, when there's that reallocation of capital in the general equity markets into a commodity, it's a violent upward movement. It's not steady. It's quick because, as I said, it's a tiny market. It's a fraction of 1% is the gold market. If you took the collective market cap of every gold company and every base metal company in the world, it's smaller than Apple. So you can imagine small reallocation, half of 1% of global equity markets being reallocated into the precious metal space. That would result in blockbuster type gold prices. It wouldn't be small. It would be significant and violent, and that would be reflected in equity valuations as well. And then the question you have to ask yourself, if you believe in that thesis as a gold investor or as an investor generally, is where do you get the best torque to the gold price? And I would argue it's in the royalty space.
Interesting. I like that. So I have just a couple of other questions for you. My first is, can you share a little bit about your company? Just what you do, how it works, and then just what your trajectory is as a company. I mean, you just IPO'd, I think, within a year, and everything's looking great. I mean, I'm sure your quarterly meetings are awesome at this point. Like, what's kind of the plan for Gold Royalty Corporation?
Well, let me take a step back and talk about the royalty model, because not a lot of people are familiar with it. They don't really understand how it works, and that's understandable. What we do, and you alluded to this earlier on, is we provide capital to the explorers, the developers, and operators. We act as a bank to help them advance their projects. What we take back in return, rather than repayments, is a royalty on their properties. And so we take a percentage of their revenue. It can be anywhere from 0.5% to 3% of the top line. And so as they produce gold, we get a statement every month, and then we collect royalties on their gross revenues. So that means we're not exposed to their operating costs. We're not talking about net profit interest or net profit royalties. We're talking about top line gross royalties. And so in this inflationary environment, that's a huge win for our shareholders, because we're giving them full exposure to the gold price upside while completely protecting them from inflation and the contraction of margins that inevitably occurs at the mine site as a result of that inflation. So that's been an overhang on the performance of the operators in our industry, in the gold industry lately, because of that overhang of inflation and the impact on their operating capital costs at the mine site. We're not exposed to that. So once we own a royalty, we never get a capital call. We never have any reason to have to put more capital to work. We just collect, we harvest our share of the revenues going forward. So we have 215 royalties in our portfolio, and we never have to put another dime into them. We just have to wait for those to deliver production, and then we harvest our cash flows from that. And again, completely insulate our shareholders from the downside that inflation creates for the operators. The other opportunity we provide our shareholders is we get full exposure to the exploration upside at these properties as well. So last year, for example, our operating partners invested $200 million US, over 700,000 meters of drilling on their properties, expand their geological resource. We got the full benefit of that upside without having to put a dime into the exploration budgets. They funded that exploration entirely. And we get the benefit of that because our royalty is not only in the existing reserves, but any growth in reserves that our operating partners achieve through their exploration efforts. So we get full leverage to the gold price, full leverage to exploration, and complete insulation from inflation. That's the beauty of our model.
That's incredible. Now, is this a completely different model than like what Barrick Gold is doing? Or is
So Barrick is an operator, and Barrick actually operates some of our best assets. We happen to be partners with them, where we have a royalty on, for example, the underground extension of Gold Strike, which is the biggest producing gold mine in the United States, in Nevada. And Barrick and Newmont are the operators. They're joint venture partners on that. So the two biggest producers in the world by market cap and production are our operating partners on one of the best gold deposits in the world, one of the lowest costs. And we have a royalty on the underground extension of that, which is just published a resource on. So they're operators. So they have to take on all of the operating risk, the cost risks, inflation. They have to absorb all that. We just get a percentage of the top line from their operations. That's true with Agnico Eagle. The third biggest producer in the world by market cap. They have Canada's biggest producing gold mine called Canadian Malartic in Quebec. We have a royalty on that as well. Agnico Eagle, I was CFO there for 12 years. I know that the asset extremely well and know their portfolio well. We have, again, a royalty on one of the best low-cost operations with the longest reserve lives in the world. So yes, we have 215 royalties, but we also have royalties in some of the biggest gold deposits in the Americas. We have a royalty on Canada's biggest producing gold mine in Canadian Malartic. We have a royalty on what will be Canada's second biggest producing gold mine in Ontario called Côté. IAMGOLD is just finishing construction of that. It'll be producing next year. And now we also have a royalty on the biggest gold mine in the U.S. On Gold Strike, the underground extension called Ren, that Barrick and Newmont are producing right now. So it's not about just the quantity and diversity of our portfolio, but we have some chunky foundational assets with decades of reserves ahead of it. That means these assets will be paying annuities to our shareholders long after I'm gone.
That's really incredible. I want to ask, putting yourself in the shoes of a retail investor, because I think a lot of people are in the same boat as I am now, because there's a lot of, like, right now it's hard to justify putting money into real estate. Interest rates are ridiculous. People are still wanting to sell their home for COVID prices or a year ago prices. They just don't want to let go of the fact that people are. So it's just this funny period of time where a lot of people are like, where do I put my money? I'm diversifying into wine and art right now, and I'm just always looking. And when I interviewed Scott, he made an incredible case for uranium with the rise of nuclear power and energy. And I took a pretty large position, into uranium royalty. And so I just want to ask you a couple questions, or just a question really. If you were a retail investor who's in the boat that I know thousands of the listeners of this podcast are right now, like, what would be your investment strategy regarding gold with your dollars? What would you do?
Yeah, I mean, there's a few ways to play gold, and I talked about earlier on. You could buy physical gold, for example, and it's easy enough to do. You can either buy
Right.
buy it at a bank, and then you have to store it and either hide it under your mattress. Of course, there's security concerns around that, or pay for a safety deposit box, and so there's some storage costs associated with that. You can buy a physically backed ETF on the New York Stock Exchange, and they take care of the storage for you. But of course, when you buy that ounce of gold, it doesn't grow. There isn't any leverage to exploration success. So you could buy a producer, and producers are quite often exploring and growing their reserves. They're trying to anyways. But of course, what you're doing is exposing yourself to their operating capital cost inflation risk, because they're absorbing that. They're the operators. They own the deposits. They own the mines. They have to operate them and absorb inflation and labor costs and energy costs. The royalty companies provide you all of that upside to the gold price, upside to the exploration, but insulating you from inflation. And effectively, we're a collection of annuities. And as a result of having these foundational assets, we have good cash flow today. But with 215 other royalties, we have the highest compounded annual growth rate in revenue in the entire royalty space is 60% per annum.
Jeez.
And we pay a 1.5% yield, which 10 months into our existence, we introduced a dividend because of the quality of our royalty portfolio. We have a 1.5% yield today. And given that growth rate that we expect in our revenue and the fact that our costs are extremely flat, I have 8 full-time employees, and I could run a business 10 times the size with the same 8 employees. We have very small G&A, and all that revenue growth goes right to the bottom line and gives us the prospect to increase dividends. I think significant potential to increase dividends as we crystallize and harvest that revenue growth from our existing royalty portfolio. And again, none of those royalties have capital calls. We own them outright. We own them in perpetuity. And so we just wait. And we wait for those mines to become productive, and then we just collect the checks.
That's incredible. 2 things you said that really, really are exciting. The first thing is how long-term you're thinking. When you said this is going to produce far out past my life, it's really powerful when you interview somebody that they're thinking beyond their own lifetime, because so many people don't in this space. It's like, well, when I die, the company, it's just like, I love that. And then the second thing is just your economies of scale with being able to grow 10 times with the same amount of staff. I mean, that's so attractive and rare just in business in general. Cause it's like with restaurants or most companies, you have to increase your overhead tremendously to grow. So I think that's really, really, really powerful. So my final question is can you share a little bit with everybody, your ticker symbol, how to invest, all of that? Actually, I'm so sorry. I did have one question. Do you already pay dividends, or are you more of a growth company at this point?
We do. So 10 months after our IPO, we introduced the dividend. It's 1 penny per share per quarter, which equates to about a 1.5% yield at current share prices. And as I said, with 60% compounded annual growth in our revenue and the fact that our G&A costs are flat, so it's a very scalable business, means that we think there's high potential that dividend will increase over time.
That's amazing. That's awesome. So your ticker symbol is, if anybody, because I have a few different platforms, but even on Robinhood, you're there. So what is your symbol and where are you traded?
We're on the NYSE American, and the trading symbol is GROY, G-R-O-Y, just like Gold Royalty Corp.
Awesome. My very final question, because I didn't ask Scott this, it's just, knowing the connection with all of you and Amir now, and like you guys are like the 9,000 pound gorilla in the commodities space. Can you who is Amir, and how did he become this mega in the space that like him and you and Scott? All of you guys are just crushing the market. How did he get his start?
Well, I joke with him. He's an overnight success, 20 years in the making. He's an extremely patient value investor. And he did it in the uranium space and waited and accumulated one of the largest reserve bases in terms of productive uranium assets in the Americas. Ones that he can restart very quickly. And he waited for the uranium price to start to show some life before he started to put serious capital into them. Similarly, he accumulated a dozen development stage gold assets through the bottom of the cycle coming out of the credit crisis. And he just waited. He knew the cycle would eventually turn. And when he approached me after I completed the Goldcorp Newmont merger in 2019, he had these assets accumulated 12 to development stage assets in the Americas, 32 million ounces of gold resource on them, and asked me, how should we crystallize value now that the gold cycle is starting to turn in our favor? And the first thing we did was royalties on each of those assets and created Gold Royalty Corp, which created significant, immediate value for gold mining shareholders because they had a piece of the action in the royalty company. They own 15% of Gold Royalty Corp to this day. So a royalty portfolio that had no value within gold mining has significant value in gold royalty, and they have a piece of that. And that has allowed them to start to reinvest capital back into those assets, which has allowed them to be de-risked and advanced and eventually become productive assets in an industry that's starved for growth. As I said, reserves are down 40%, and Amir has the keys to the kingdom with a dozen development stage assets that these producing companies desperately need. He has something he can sell to them and create significant value for gold mining shareholders, as he did in helping me create Gold Royalty Corp as a co-founder of Gold Royalty Corp. So a tremendous entrepreneur, value investor with a fundamental understanding that paper is infinite and commodities are finite.
That's right.
And eventually the cycle turns as increasing amounts of fiat currency chase those fewer and fewer dwindling hard assets available in the commodity space.
What an incredible operation you guys have. I can just imagine the conversations over cigars when you guys are all together. So that's awesome. David, this has been an absolute pleasure. I just want to thank you. I really, really think you delivered a tremendous amount of value to the listeners. I know I learned a lot about just the cycles and gold in general, and, just a lot of the things that you share that I did not know. And so I really appreciate your time. I can't wait to release this episode so that everybody can hear it and learn from it. But thank you for your time. And hopefully once it is at $3,000-$4,000 an ounce, I can have you back on here and you could be like, told you. So thank you for your time, David. Really, really appreciate you being on here today.
Well, thanks, John. And we'll see you on the North Shore at some point. We'll have a coffee together.
Yeah, absolutely.